Hello, everybody. This is Dari here. Today, we're going to talk about stock screening. Okay, stock screening. What are we going to say about it? First of all, we are going to look at Warren Buffett 4 rules of investing. One of them is debt to equity ratio. We also look at current ratio. We talk about some resources that will be useful for you, and that is how we're going to end this topic today. So, Warren Buffett 4 rules of investing. So he has a basic 4 rules. But before then, let's look at who is Warren Buffett. I know majority of you will know who Warren Buffett is, but let me quickly show you this. Who is Warren Buffett? Currently is the number 4 richest in the world. This is Forbes. We all know what Forbes is. So it's number 4 richest in the world. Is the CEO of this company called Berkshire Hathaway. Currently is worth 98 billion. He is known as the Oracle of Omaha, one of the most successful investors of all time. So if you are going to study anybody about investment, this is the guy you want to study. So he runs this company which owns more than 60 other companies. Okay, look at it. He first bought his stock at age 11. Come on, guys. This guy has been in this business since eternity. And what I like him as much is he has promised to donate 99% of his wealth. So he partnered with Bill Gates in 2010, and they gave huge amount of money to charitable causes. Okay, so this is the guy. So he is very rich and he has lot of experience. All right, so now we're going to talk about his 4 rules. Rule number 1, vigilant leadership. Rule number 2, long-term prospect. Number 3, stable and understanding. Number 4, intrinsic value calculation. What those 4 rules mean? Before you choose any stock, you need to consider these 4 rules. Okay, are the leadership of those companies, are they vigilant? That company, does it have a long-term prospect? Is the company stable? Do you understand the product of that company? What about the intrinsic value of that company? Is it very, very solid? Okay, these are the 4 rules. But today, we are only going to cover the first rule, which is vigilant leadership. Okay? So the first rule is vigilant leadership. Okay? So what it's telling you is that you should find a stock or business that has great management. Okay, a stock must be managed by vigilant leaders. What that means is that the leader should be observant and attentive. They should always be on the lookout for danger. In business life, there is no greater danger than not being able to meet your debt obligation. If cases that happen, creditor can claim liquidation of the company. So the most important thing for him as an investor is to look at how the company is being managed in terms of debt. Do they get themselves into debt? Do they manage their debt properly? So the first thing we're going to look at now is what is debt to equity ratio. We're going to look at that. What is current ratio? And we are going to understand what level of debt are acceptable. So the first thing we are going to talk about is debt ratio. So what is a debt ratio? Okay, the debt to equity ratio is calculated by dividing company's total liability by its shareholder equity. These numbers are available on the balance sheet of a company financial statement. So sometimes we refer to it as debt over ratio. The key ratio is comparing the debt of the equity in the company. So you are going to compare what the company owes to what the company has. Okay? So Warren Buffett prefers a company with a debt to equity ratio that is below 0.5. In other words, less than half. So the debt is less than half of what the company has, the equity the company has. So if a company has less than half of debt to equity ratio, that is, debt to equity ratio is 0.5 or less, Warren Buffett is interested. Otherwise, he's not interested. Let's look at the next one, current ratio. So this is a ratio compare how much cash is expected to be converted to cash in the next 12 months, right? So what that means is you are looking at what money is available to meet the next 12-month obligation. Okay, so a company must have enough cash in available to meet their next 12 months obligation. So what it does is it tries to calculate the current ratio, which means is the current asset divided by current liabilities. So what you have as asset over what you owe as a liabilities. That must be up to 1.5. So you must have more in your locker than what is your liability, right? So if it is 1.5 or above, Warren Buffett is interested in that. Otherwise, he's not interested. Okay, so we've said about current asset, which is the how much cash is expected to flow into the company in the next 12 months, and liability is the opposite. How much cash is expected to flow out of the company. So when you put the flowing in over the flowing out, it gives you that current ratio we talk about. And the current ratio for Warren Buffett must be at least 1.5. Okay, so these are the resources we are going to use. I will leave this link in the under the description so you can go and check it out. Today this Warren Buffett books is a very good resource place you can go for training about its methods. This MSN is a stock screener. The Market Watch is a stock screener, and the Yahoo Finance is also a stock screener. So we are going to look at one of those stock screener and see if it can help us. So we're going to look at the MSN Money. Let's try and look at MSN Money. Okay, so I'm going to bring it here. Okay, so MSN Money, here you can search for any company you want. Let's say you want to look for Disneyland, DIS. Let's look for Disney. Yeah, this is Walt Disney. Yeah, so Walt Disney. So you want to look at that company. So what you are looking for now, if you are following Warren Buffett through, you are looking for a current ratio and you are looking for debt to equity ratio. So let's see, we go to analysis. Let's see. All right, so for here you can see for Disney, debt to equity ratio is what? 0.63. Okay, 0.63 is still greater than 0.5. So for example, at this point, Warren Buffett will not be interested. Look at the current ratio is 1.31. So at this time, he will not be interested. He wants this value to be 1.5 and that value to be less than 0.5. It doesn't mean that these guys are not doing okay. It just means that he hasn't reached what he wants. Okay, let's search for Google, for example. Let's look at Google and compare it. Google, which will be, let's look at the NASDAQ. Google NASDAQ. So we're going to look at the same thing again, analysis. On the analysis, we want to see like analysis. Okay, look at debt to equity ratio. Great stuff, innit? 0.06, that is what you're looking for. 0.06 less than 0.5. Look at the current ratio, 3.07. So Warren Buffett stipulate 1.5, this passed it. Here, less than 0.5, it passed it. So it will put this particular stock, for example, in his watch list because it has the other 3 rules that he has to apply. This is just the rule number 1. Okay. Let's search for one more company. Let's search for Amazon. Okay, Amazon. Yes, Amazon. This one here, Amazon, which is NASDAQ. Let's look at what they got. So you go to analysis and you scroll down. Look for Amazon. Debt to equity ratio is a little bit more than what Warren Buffett will look for, and the current ratio is less than what he will look for. So you can see straight away we have looked at 3 companies. For Warren Buffett, only one meets his criteria, and it doesn't mean that he's just going to buy it. He's just going to put it in his short list, because, as we said before, he has 4 criteria. So the first one is vigilant leadership. And how does it measure the vigilant leadership? By looking at the debt to equity ratio and also looking at current ratio. If they meet those 2 criteria, then rule number 1 for Warren Buffett is sorted out. So then it will apply the next rule, which is the long-term prospect. Then it will apply the third rule, which is the stable and understanding company. And the last rule, it will calculate the intrinsic value of that company. So that is where we're going to stop today. Hopefully, the next lesson, we will talk about the second rule of Warren Buffett of investing. Thank you for listening, guys. Take care.